How did Apple become one of the most valuable brands in the world without spending most of its history trying to sell the most smartphones? In the second quarter of 2025, Apple accounted for roughly 17% of global smartphone shipments. That meant most smartphones sold around the world were not iPhones. But just 1 quarter later, Apple captured about 43% of global smartphone revenue. That gap reveals something important. Apple did not need to control most of the market to capture a much larger share of the money flowing through it. For decades, the standard logic of consumer technology has been simple. Sell more units, reach more users, enter more price segments, expand distribution, push market share as high as possible. And in many industries, that logic works. A larger customer base can create scale. Scale can lower costs. Lower costs can support lower prices. Lower prices can attract even more customers. This creates the impression that the strongest brand is usually the one with the widest reach. But Apple has often behaved differently. It has maintained higher prices. It has kept a relatively focused product lineup. It has avoided competing aggressively in many low-cost segments. And it has repeatedly accepted the fact that millions of customers would choose cheaper alternatives. On the surface, that looks like a limitation. Every customer who buys another phone is a customer Apple did not capture. Every market where price matters more than experience appears to favor a competitor. Every lower-cost segment seems like an opportunity Apple has left behind. Yet the result has not been a weak or marginal brand. It has been a company capable of generating extraordinary revenue from a smaller share of global unit sales. A company whose products remain recognizable across markets. A company whose customers often pay more, return for new devices, and continue spending inside the same ecosystem. That creates the central puzzle. Why would a company with Apple's resources, distribution, and global recognition choose not to pursue every possible customer? Why protect higher prices when lower prices could increase volume? Why maintain a selective position when broader coverage could expand market share? And why has this approach strengthened the brand instead of restricting it? The answer begins with a distinction that is easy to overlook. Market share measures how many units a company sells relative to its competitors. It does not automatically measure how much customers are willing to pay, how long they remain loyal, how consistently they experience the brand, or how much economic value each relationship creates over time. Apple appears to have optimized for a different kind of scale. Not simply the largest number of users, but a system in which product, price, design, retail, software, and service reinforce the same expectation. To understand why that matters, we need to look beyond the iPhone itself. We need to examine how Apple learned to control not only what it sold, but how the entire experience was presented, purchased, and remembered. That approach did not emerge by accident. From the beginning, Apple gradually made a series of decisions that looked unusual in an industry obsessed with variety and volume. Instead of offering dozens of models across every price point, the company kept its portfolio relatively narrow. Instead of allowing every retailer to define the customer experience, Apple increasingly sought to control it. Instead of treating hardware as a standalone product, it designed every major component to reinforce the same experience. This philosophy became much more visible after the return of Steve Jobs. Apple simplified its product lineup, reduced unnecessary complexity, and focused resources on a small number of products that could each represent the company at its best. The objective was not simply operational efficiency. It was consistency. Consistency matters because a brand is built through repeated expectations. Every advertisement creates an expectation. Every product either confirms or weakens it. Every store visit either reinforces trust or introduces doubt. If those experiences vary too widely, customers stop associating the company with a clear identity. Apple attempted to eliminate that problem by controlling far more of the customer journey than most consumer electronics companies. The Apple Store became one of the clearest examples of this strategy. By the end of fiscal year 2010, Apple operated 317 retail stores around the world. According to the company's annual report, these stores were designed not simply as sales locations, but as places where customers could learn about products, receive technical support, and experience the ecosystem directly. That distinction was important. Most retailers optimize for transactions. Apple's retail strategy also optimized for perception. Lighting, product placement, architecture, employee training, technical support, and even the pace at which customers explored devices were carefully designed to communicate the same message. The product was never presented in isolation. The store itself became part of the product. The same pattern appeared across the rest of the business. Industrial design reflected simplicity. The operating system emphasized ease of use. Packaging reinforced premium quality before the device was even turned on. Customer support extended the experience after purchase. Services remained closely integrated with hardware rather than existing as unrelated businesses. Each individual decision may have appeared small. Together, they created something much more difficult for competitors to copy. Not because competitors lacked engineering talent, but because they often optimized different objectives. Many manufacturers expanded rapidly across dozens of devices, multiple operating systems, numerous retail partners, and highly fragmented pricing structures. That approach increased reach, but it also made it harder to deliver the same experience everywhere. Apple accepted a different trade-off. A more selective portfolio meant saying no to many opportunities that could have increased short-term sales. Maintaining premium pricing inevitably excluded large groups of price-sensitive consumers. Limiting product complexity reduced flexibility in certain markets. These choices came with real costs. Yet Apple appeared willing to accept those costs in exchange for something it considered more valuable, preserving a coherent identity that customers could recognize regardless of where they encountered the brand. At this stage, none of these decisions automatically explain Apple's extraordinary financial performance. They explain something more fundamental. Apple was building a business in which every major interaction supported the same promise. The question is how that consistency evolved from a branding philosophy into a competitive advantage capable of producing exceptional economic results year after year. That philosophy became economically powerful when Apple stopped treating every product as the end of the customer relationship. Instead, each device became the beginning of one. An iPhone was no longer just a smartphone. It became an entry point into software services, accessories, cloud storage, payments, entertainment, technical support, and eventually additional devices such as the Apple Watch, AirPods, Mac, and iPad. Each new purchase made the next one more valuable. This changed the economics of growth. Many technology companies depend heavily on selling another device to generate another wave of revenue. Apple gradually built a system where a customer could continue creating value long after the original purchase. That shift is visible in the company's financial results. During the first 6 months of fiscal year 2025, Apple generated approximately $219.7 billion United States dollars in net sales. Gross profit exceeded $103 billion United States dollars, producing a gross margin close to 47%. One figure stands out in particular. Services generated nearly $53 billion United States dollars during the same period. By the first 9 months of fiscal year 2025, services revenue had grown to more than $80 billion United States dollars, while total gross profit reached almost $147 billion United States dollars. These numbers reveal an important pattern. The business was not relying exclusively on convincing new customers to buy their first Apple device. An increasing share of value came from maintaining relationships with existing customers. Apple has repeatedly highlighted another indicator alongside its financial results. The company reports that its installed base of active devices has reached an all-time high across product categories and geographic regions. Executives have also consistently pointed to exceptionally high customer satisfaction and loyalty as drivers of continued growth. Those statements matter because they describe a different competitive objective. Instead of maximizing the number of first-time buyers Apple focused on increasing the lifetime value of customers who had already entered its ecosystem. Viewed this way, the company's decisions begin to connect. Premium pricing protected margins. Integrated hardware and software improved the overall experience. Retail stores reinforced trust. Services deepened engagement after purchase. Accessories extended the ecosystem. Each component strengthened the others. The result was not simply another successful smartphone manufacturer. It was a business in which every major product increased the usefulness of the products customers already owned. That interaction made switching more costly, not necessarily because customers were forced to stay, but because remaining inside the ecosystem often delivered greater convenience. Eventually, this strategy produced scale in a different form. In 2025, the iPhone 16 became the world's best-selling smartphone, and Apple placed 7 models among the 10 best-selling smartphones globally. That achievement is easy to misunderstand. It did not happen because Apple suddenly abandoned its long-standing approach and began competing aggressively across every price segment. It happened after years of building an ecosystem that encouraged repeat purchases, reinforced customer loyalty, and justified premium pricing. In other words, strong sales became the outcome of a broader system rather than the starting objective. At this point, the evidence points toward an unexpected possibility. Perhaps the defining advantage was never Apple's willingness to charge higher prices alone. Perhaps it was the discipline to organize every major decision around preserving the same customer experience, even when that meant leaving substantial portions of the market to competitors. The evidence now suggests that the common assumption may be pointing in the wrong direction. It is tempting to believe that Apple built a powerful brand first and then decided it no longer needed to chase market share. But the sequence appears to be almost the opposite. Many of Apple's decisions make more sense if the company was protecting the conditions required to build a premium brand, even when those decisions limited short-term expansion. Consider what happens when a company aggressively pursues every customer. It usually introduces more price points. It expands the number of product variations. It serves increasingly different customer expectations. It depends on more distribution partners. It competes more directly on price. Each decision may increase sales, but each one also makes it harder to maintain a consistent experience. Customers buying the least expensive version of a product often evaluate it differently from customers buying the premium version. Retail partners present products differently. Software support becomes more fragmented. Product development must satisfy increasingly conflicting priorities. Over time, the brand can become associated with accessibility rather than distinction. Apple accepted a different trade-off. Instead of asking how many customers it could serve, the company repeatedly asked how many customers it could serve without weakening the experience that defined the brand. That distinction changes the entire strategy. Higher prices were not simply a tool to increase profit per device. A focused product portfolio was not only about reducing manufacturing complexity. A carefully controlled retail experience was not just another sales channel. Together, these decisions protected a consistent perception of quality. Research on luxury and premium branding supports this logic. Studies have found that perceived scarcity and exclusivity can strengthen the value customers attach to a brand, not only through functional performance, but also through emotional and social meaning. When customers believe a product represents a distinct identity rather than a widely available commodity, they often perceive greater value even before considering technical specifications. This does not mean scarcity alone creates a strong brand. Artificial shortages without meaningful value eventually lose credibility. Customers do not continue paying premium prices simply because something is difficult to obtain. They continue paying when limited availability is supported by superior design, consistent experience, trusted quality, and a clear identity. Apple appears to have combined all of those elements. That also explains why many competitors have spent recent years moving upward into premium segments rather than relying entirely on low-price competition. The most profitable parts of the smartphone industry are increasingly concentrated around products capable of sustaining stronger pricing and deeper customer relationships. Viewed from this perspective, leaving part of the market to competitors was not necessarily a failure to expand. It was a way of concentrating investment where the company believed it could create the greatest long-term value. The objective was never to reject growth. Apple continued expanding internationally, introducing new products, and increasing its installed base. The company simply avoided expanding in ways that would undermine the identity supporting its pricing power. Seen this way, market share becomes a consequence rather than the primary objective. A company can gain millions of additional customers and still weaken its competitive position if every new customer forces the brand to become less distinctive. Conversely, a company may deliberately decline certain opportunities because preserving a coherent identity creates greater value over decades than maximizing unit sales in the next quarter. That possibility leads to a broader conclusion about how branding and business strategy interact, one that extends well beyond Apple itself. Looking back, Apple's story becomes less about refusing to grow and more about deciding what kind of growth was worth pursuing. The evidence points to a company that repeatedly protected the same set of priorities: a focused product portfolio, a tightly controlled customer experience, premium pricing supported by perceived value, an ecosystem designed to strengthen every subsequent purchase. Long-term relationships that continued generating revenue long after the original device had been sold. None of these choices guaranteed success on their own. Many companies have launched premium products. Many have invested heavily in design. Many have attempted to build ecosystems. What made Apple's approach distinctive was the consistency with which those decisions reinforced one another over decades. That consistency changed the relationship between branding and business performance. Instead of treating the brand as a marketing asset that supported sales, Apple gradually turned the brand into an operating principle that influenced product development, retail strategy, software integration, pricing, and customer experience. Financial performance became the consequence of that system rather than its starting point. This also explains why market share alone provides only a partial picture of competitive strength. Market share tells us how many customers chose a company during a particular period. It does not tell us how much value each customer creates. It does not reveal how much pricing power the company possesses. It does not measure customer loyalty. It does not capture how effectively different parts of the business reinforce one another over time. Those dimensions become visible only when market position is examined together with customer relationships, profitability, ecosystem strength, and the consistency of the brand itself. Apple demonstrates that these factors can become mutually reinforcing. A clear identity attracts customers who value that identity. Those customers are often willing to pay premium prices. Higher margins create resources for continued investment in products, software services, and retail. Better experiences strengthen loyalty. Greater loyalty increases the lifetime value of each customer. That in turn reinforces the identity that attracted customers in the first place. The cycle becomes self-supporting. From this perspective, the company's willingness to leave parts of the market to competitors appears less like a sacrifice and more like a strategic boundary. Every business faces opportunities it could pursue. The more difficult question is which opportunities would weaken the qualities that made the business valuable in the first place. Apple's history suggests that refusing certain opportunities can sometimes preserve advantages that are far more difficult to rebuild later. That does not mean every company should imitate Apple's pricing, product strategy, or market positioning. Those choices depend on industry structure, customer expectations, and competitive realities. But Apple's experience illustrates a broader principle. A powerful brand is not necessarily created by reaching everyone. It is created by making every decision consistently reinforce the value promised to the customers a company deliberately chooses to serve. In that sense, the relationship between branding and business value looks very different from the common assumption. The strongest brands are not always those that capture the largest share of the market. Sometimes they are the ones that understand exactly where not to compete, because protecting a clear position can create more lasting value than winning every possible customer.